Hey everyone, it's Evan here from the Trade Risk, and welcome back to Stock Market Weekly, your episode for Friday, May 9th, 2025. This is the show where we break down the notable moves across financial markets in 20 minutes or less. So make sure you are subscribed to our YouTube channel, hit those notifications so you never miss an episode, so you're always prepared for the week ahead. I hope you're doing well out there. Thanks again for tuning in. It was a pretty quiet week for markets, which is kind of a nice, refreshing change of pace. It's been really fast-paced for the past month or so, and things slowed down a little bit. Markets digested. We didn't have too many catalysts this week. We had the Fed out on Wednesday on their latest interest rate decision, but it really wasn't a live meeting. There wasn't a expectation that the Fed was going to move, and they didn't. They kept the Fed funds rate still at that 4.25, 4.5 range, and Jerome Powell basically kind of kicked the can down the road more, basically saying data dependent, economy's resilient, some tariff uncertainty, inflation's kind of in check, all the stuff we're used to. Surprise, surprise, nothing new out of the Fed. So to the next meeting we go, where it gets maybe a little more dicey on whether or not they would move in June. Now, the other announcement we got this week was a trade deal out of the US and UK. So there's, I guess, a little bit of encouraging progress there that those negotiations are moving forward. The elephant in the room, though, really is China, and it is, very uncertain as to where that relationship and conversation actually stands. And so we're just going to have to wait and see. In terms of markets, I mean, structurally, I think one of the more meaningful moves was potentially gold. Gold made a run back up to those prior highs and then kind of failed gracefully, but it could be signs of a double top, longer consolidation brewing there. And we really are just going to be asking the question, I think, for the stock market is, how long can this momentum last? Can we stay up and bid? Can we consolidate, work things off sideways, and then make another leg up? Or do we have to go revisit those lows? We're going to look at some of the data in this week's episode. Before we do, let's shout out our sponsor, Investors Business Daily. They do help make this possible, and we've got links down below. Help support the show and get yourself some discounts to Market Surge and their IBD digital platform. I use both of them every day, so make sure you check them out when you're done with this video in the description of this show. And now let's get into it. All right, here we go. Slightly different intro view here. We're going to get into TC2000 in just a moment, but we're going to start off with some custom charts that come from us, from our internal software tool database that we've been maintaining for some time. And now I'm finally getting around to sort of extending it to be able to generate charts that look a little more pretty and interesting and informative for display for the Stock Market Weekly video and maybe for our newsletter as well. So this is like a database that I've been using for years to do research, generate trade signals, all kinds of fun stuff, but I've just never had kind of a front end for it, or I've never been able to just kind of generate charts easily. It's always been spreadsheets. And so now we're going to get a little bit of taste. I think the hope is to be able to look at some more interesting data using some of the other important metrics that I tend to track that aren't easily showcased prior. All right. So just a little bit of a taste. I'm still working things out, working out kinks. I'll get the flow down and I'll get some different views for us as we move along here. But let's start it off with our, this week at a glance, just a high level overview. I've got the indices in the top left here. Basically, you can see, Russell 2000 was the standout leader this week, up 0.16%, but it was pretty much a digestion week. It was flat-ish across the board, slightly negative as we go down the list here. SPY was down just under 0.5%. So after such a strong run, a little bit of a digestion week, certainly welcomed, and that's what we got this week. If we look in the top right, this is the VIX. We see this continue to cool off this week. We had a little bit of a spike up on Tuesday, and then we just kind of drifted lower into the weekend, going out at 21.90, down almost 2 points this week. So fear continues to come out of this market. If we look in the bottom left here, we got the US dollar, which was up this week about a 0.5 point. So, again, kind of finding its bottom and stabilizing a little bit, not in pure like sell-off mode like it was for the majority of April. And then, of course, in the bottom right here, we've got treasury yields. 10-year treasury yield up a bit this week, but pretty much unchanged. So again, kind of a cool, calm, collected week. Not a lot of craziness out there this time around. Now, if we take a look at sectors here this week, we can see, not going to be able to do this full screen, so we're going to have to work on that bug right there. See how that doesn't quite maximize? These are all the fun things. If we look at sectors this week, though, we do have leading the charge here. Let's see if I can pull that back up. There it is. Leading the charge here, we've got XLI up 1%, XLK, XLU. Those were kind of the three standouts here: utilities, tech, and industrials. On the downside, it was real estate, it was healthcare, and it was materials. Eli Lilly was a big laggard this week on healthcare, down 3%. So that was pretty meaningful underperformance, and we'll look a little bit closer at that in just a little bit. Now, if we get into the slightly more fun and interesting slides and data views, here is market internals, and I've got lots of different ways to track this. Our favorite here is 52-week highs up top left, 52-week lows in the top right. You know, you're still seeing, pay attention to the scales because they are a little bit different here. We're seeing a slight increase here, right? We're starting to make our way back up here in 52-week highs. Still pretty subdued levels, though. We're kind of in that no man's land territory we talk about, where we're not quite making an acceleration of highs, not quite making an acceleration of lows. So we're kind of meandering here, but a little bit of building. This goes to Thursday's session. We don't quite have Friday's data yet, just because my data hasn't come in at the time of recording this. Take a look in the bottom left, though. Percentage of S&P 500 stocks above a 20 SMA. I mean, we're still pretty much at nosebleed territories, right? Two standard deviations up. We kind of tagged that just last week, and we're still hitting up 80% or so of stocks above their 20-period simple moving average. Put call ratio kind of just in no man's land here, so nothing too interesting. So we're going to come back to a couple of these slides in just a little bit, but let's get into the S&P 500 price action analysis here. And again, we sort of talked last week about this rally that we've been seeing, the chase that's been on, but the fact that we are starting to now bump our head into these prior overhead supply, and that it would likely cause, a little bit of chop, two-way trading, and some resistance, let's call it. And we got that this week. I mean, last week when we had our last video update, we talked about some of the froth that's been in the market, but that bulls had the momentum to the upside. Remember, we were coming off of 9 days up in a row. We were breaking records. And, we started the week off with some good digestion. We got a pullback day on Monday. We got more pullback on Tuesday. And then we kind of stabilized and went sideways Wednesday. I mean, that 3-day reset, even though it wasn't a tremendous amount from a price retracement perspective, was at least enough to work off some of those extreme overbought conditions to allow, some shorts to maybe cover a little bit. I know I was sort of in that category on some shorts that we were shorting in our trading systems on the way up on this latest leg. So we got to cover a little bit and save some face. You got to look for lower probability entries on the long side to get just even a couple of days of a reset. And then we kind of springboard up towards the end of the week. Now, the end of the week was a little bit weak for the S&P 500. I mean, again, it was an inside day on Friday. We couldn't quite take out last Friday's highs. So we already have just some of the, footprints here of a market that wants to maybe consolidate and get a little more choosy on, where capital really wants to rotate here. Again, I think we talked about last week, a move towards 5,800 is still, potentially kind of in my head where, we may want to settle before we get a more meaningful multi-percent correction or pullback. But For now, we're grinding, we're taking our time, we're going sideways here, and we'll see, kind of where things land next week. It does feel like, we've got just a shorter term range that is developing here, call it between 5560 and 5700. So let's keep an eye on this spot. Maybe we get a few more days digestion in here, and then we figure out the next kind of breakout move. That would make sense to me. And again, let's just be mindful of all of this prior supply here. It seems like, from a sentiment standpoint, this rally is still pretty hated, generally speaking. I feel like sentiment was hated on the way down, right? I mean, sentiment was terrible going down, and it's really not budging too much coming back up. So that's the kind of curious spot here, but positioning is clearly off sides, and the market's just kind of climbing that wall of worry and that pessimism right now. And eventually we'll equalize, and then we'll, potentially make that next directional move, and maybe it's back down. But for now, right, the trend is up. Things are consolidating and chopping. We're stuck in between some interesting levels. Remember if we go back to our smart trend filter indicator on the indices here, right? And we look at, this positioning here of having the daily uptrends and weekly uptrends competing with one another, right? So from a daily perspective, we have these daily uptrends that have been in place now for the past few weeks. And we're starting now, if we go to the weekly time frame on all these charts, we're starting to get towards the testing kind of the longer term trends, at least the way we measure weekly and daily trends using our smart trend filter indicator. And so we're starting to challenge and try and get crosses up and trying to kind of, repair a lot of that big April, March sell-off. And so this is where markets, I feel like, are going to, struggle, tug of war, dance a little bit to see if buyers really are willing to drive us north of that 5,800 area, let's call it, and start to repair some of these bigger, longer term charts. Will this be a true V-shaped recovery like we saw in COVID and other instances in market history, or is this going to be, kind of more of a consolidation and whipsaw type of market before we get the big recovery? So that's what we're still waiting to see right now. I think we're at some interesting spots. Daily uptrends meet weekly downtrends, and we're going to start to see that turbulence here is what I would expect. If we take a look at the Nasdaq 100, again, you got kind of a similar situation this week. We had the nice little pullback, we had a little sideways, and then we went up to finish the week. Inside week here on Friday, so we're set for maybe a little vol expansion on Monday, but generally speaking, you still have this overhead supply up here. We're coming right back towards the pivot high here from March, the end of March, before we rolled over on Liberation Day, and so price has memory, and it's certainly, getting a little dose of that right now. The levels here for the Nasdaq 100 would be this nice little mini range here, call it 478 on the downside. If we can stay above that, then things are pretty innocent, harmless, and we can float. But if we start to, make a meaningful move below 478, then, let's be a little more cautious if something like that gets underway. Now, one of the charts I wanted to show again back from our database of charts, and here we go, my full screen mode isn't working, so I'll work on that, but I'll keep it at this size. But this is looking at the QQQ, and this is looking at 21-day rolling returns. So basically just what's the performance over the last 1 month. And take a look at the move we saw from down 14% to all the way to, nosebleed territory up here. If I were to throw on my standard deviation here, 2 standard deviation move up here to north of 15%. That's a pretty extreme reading. That's a pretty good thrust to the upside. But what you'll notice is, and I could take this back further, I don't know if I can do it in real time. Let's see if I can. Let's go to a 10-year chart. Let's see if I can. Yeah. So it's just not going to look as So this is going back 10 years. And again, if you take a look at where we wicked up here in terms of 1 month returns, you can see that going back 10 years, I mean, we basically only beat that, or we only had that type of magnitude move was COVID time, when we had that super V-shaped recovery. But what you'll notice is when you accelerate up and you kind of blow off in that fashion, you're coming back down. Gravity is going to start to do its work, and it's going to bring you back down towards the mean. And so that doesn't mean we have to crash, but it does imply, again, that like consolidation here after such a sharp move up is probably where, we're going to be headed going forward. Now, we could still grind a little bit higher, but to expect another V-shaped recovery, I mean, it just gets harder and harder to really manifest if you think you can keep up this pace for the next short few weeks. So let's keep that in mind. That's a couple of different ways to basically say things don't have to fall apart. Things could just chop around, and let's appreciate that and prepare for that as best we can. We talked a little bit about the VIX at the top of the show, coming in back down towards that 20 level. So very impressive, retracement pullback here in volatility. Do want to talk about gold. So gold here made a pretty quick run up to start the week, and it looks like it basically challenged the old high here, got to almost a new closing high, and then it backed off. So this could be the sign here where we just got the retest. We kind of failed and made a slightly lower high, and we might just be in store for a slightly longer correction, consolidation, pullback that might take us down to, the 280s or so. I mean, if you throw on a trend line of this past trajectory here, I mean, you could make the case for, again, a move back down into 285 or so. I still think gold is in play. I think it's something that will probably get bid again, but I wouldn't be surprised, again, if we throw on rolling returns on gold over a longer term period. I mean, you're going to see that really accelerated up, made a huge move, and now it's due to perhaps calm down a little bit. So that's something of note. It feels like we could just consolidate there. I don't hate gold, but I just don't know that it can continue to accelerate up here. Speaking of gold, let's talk about Bitcoin. That had a big move this week. It's 103,000 now. It's back over the six-figure mark. Bitcoin has been that momentum V-shaped recovery, right? So again, there is a case to be made. I'm going to take the other side of the case of consolidating in the markets, but Bitcoin has basically been V-shaped to new highs. And so one could say that Bitcoin is leading what the equity markets might do, right? There is a scenario where the equity markets could just entirely come right back up towards those prior highs. I still don't think that's the likely scenario, but Bitcoin is certainly, leading the charge here. After it bottomed out under 75,000, it's had some thrusts up. Tight orderly consolidation sideways, thrust up, tight consolidation sideways, another thrust up here. And now we're talking about a market that is 4%, 5% from its prior all-time highs. There's lots of blue skies, momentum, and air pockets if this thing starts to really get going over 108. Again, I wouldn't necessarily expect it. I feel like it could digest a little bit here, but it's certainly been a wonderful spot to be invested in these past couple of weeks. Our trading system got back involved. Our long-term trend following system, Galahad, did get back involved in Bitcoin, or in IBIT, right in here about a little over a week ago. So we're long. We have a position. I have a position. Long Bitcoin looks good, and still, secularly is one of my favorite ideas longer term. It's been that way. I've been saying that since the ETFs came out, and I don't see anything changing. So Bitcoin, to me, a little overheated in the short term, but certainly looks good. And now let's take a quick look at some individual stocks, and then we'll call it a wrap here. I do have, again, I have some other views I want to start presenting here from our software, but it's just not ready. And having a 2-month-old here isn't making things any quicker on getting those development done. Google was notable this week. So Mag 7 stock down 7%. Clearly didn't get the memo of rally mode. And this was off the heels off of some testimony out of Apple, basically saying that their web search browser or their web search searching is down, and Google took a pretty good hit off of that, and continues to be in a pretty tough spot here. It's in correction mode. It's good debate here, value versus value trap. It's trading at historically cheap kind of PE multiples, but you just have to question of whether or not the business is is fractured after the advancement of all these chat language models that are basically eating Google search's lunch. Disney here had a huge move this week, up 14%. So nice to see, but still hasn't gone anywhere. I mean, this stock is one that I think so many people want to own and love, but it's just has not performed since 2015. It's been absolutely dead money. And then if you do think we're going to have a recession, then it's going to be a tough spot. But here's the big level you got to pay attention to in Disney. Over 123, I think you could probably own it, and it could perhaps even run quite significantly. But until and if it starts to clear some of those big longer levels here, I mean, I think it's just a very difficult sideways kind of trap right now while other things work. But we'll see if that changes. And Eli Lilly, so this was lagging on the healthcare sector this week. So this fell after earnings. I don't know if there was any other news that came out on it. I know there was some healthcare related administration stuff hitting the tape on drug pricing, but Eli Lilly here, I mean, this had a monster move over the past, I mean, frankly, years. And so digestion here this year, it's down 5% on the year. It looks like longer term, it's just in consolidation mode. So kind of like Disney, it's just not that interesting right now because it's trapped in a lot of structure and a lot of, basic holding pattern in the longer picture. So that's kind of it. That's what I have for this week. It was, again, not something, not a whole lot going on. I think we're in digestion mode here. We'll see if this momentum can continue to persist in the markets. As long as we don't break down, again, never short a dull market, we could just chop around and work off those conditions. And then we'll see, what the month of May brings. So that's what I got for this week. Thanks so much, as always, for tuning in. Don't forget, we got links in the description of this video. If you want more from IBD, if you want more from us, check out what we have available at thetraderist.com. Thanks so much for tuning in, and we'll see you back here in the next episode. Take care.